As we've dug into the alternative investment space, I've learned a lot myself. And part of that is being podcast host and talking to fascinating people. And part of that is the research I've done to build out this class set. And in that research, we kind of came across this idea that I think financial planners get wrong a lot. And I know we have another video addressing it, but I want to show you with some math and stats kind of the issue at hand. Quite often we look at real estate as a box to check in a portfolio, right? We're going to do 5 to 10% of a portfolio in real estate, buy something and check the box. And I think that's misguided. I think that's wrong. I think that's insufficient. And the reason for that is how we look at real estate in a world of how it plays with one another and together. So I wanted to kind of build a correlation matrix within real estate, right? And so how do these different classes of assets within real estate contribute to one another, complement each other, take away from one each other, et cetera? And the big bear in the room are listed REITs. That's going to be publicly traded REITs that trade on a market you can buy. These are very big. These are very big names that we've all known, BlackRock, Blackstone, things like that. And listed REITs are going to own apartment complexes and downtown office buildings and billions and if not trillions of dollars of real estate nationwide, much less globally. So we think of real estate and we think, okay, I'm going to buy one of these, I'm going to check the box. But that doesn't always check the box. And I think it's important as wealth managers we dig a little deeper here. So we've made a grid and I'm going to build up to the grid. So the first slide here that you're looking at is just a correlation matrices of real estate classes. And it just kind of has blue indicating the darker blue, the higher the correlated asset class. So for example, if you look at private equity money and you look at listed REITs, you're going to find a very high correlation because private equity money is going after arbitrage. Listed REITs are going to go after arbitrage, right? We're not going to buy properties that don't make profit. And so both are kind of going after the same market. So you have a very high relationship between the two. You're not doing yourself any good buying a hedge fund with real estate and a REIT at the same time. So make sure if that's the market you're in, you think, okay, well, why am I buying both of these things? They're not giving me any diversification. So as we kind of take that blue and we pare down and we add some other asset classes, I think we start looking at opportunities and you see these opportunities pop in on the green here. And so we've created really one opportunity slide, I call this one, where the opportunities are going to present themselves for extra diversification. And the very first would be in timberland and raw undeveloped land. Now, notice I left farmland off this. We talked about farmland in depth earlier in the conversation. But when we start looking at timberland and land, there's tons of synergies that come to play. But the other place where we see a lot of synergies is mortgage REITs and credit. And that's because they are fundamentally different animals than a hedge fund or private equity or a physical REIT buying an apartment complex or a downtown building. With a mortgage REIT, I'm buying the notes that are financing projects, right? So I'm going to go ahead and buy the note that finances the apartment, or I'm going to buy the note that redeveloped the office building. I'm buying the debt, not the actual real estate. So when you look at something that's buying debt, how is it going to make money? It's going to make money from coupon payments. When times are good, we're going to get all the coupon payments. When times are bad, we're going to pause the coupon payments. We may lose some coupon payments, right? So 2008, not a great year for mortgage REITs or credit. There's definitely risk here. But when we pair a mortgage REIT and credit with physical property, you kind of get the best of both worlds. Because the value fluctuation of the property is very much interest rate and geopolitical sensitive. It's geographically sensitive. Based on where you're buying and what you're buying, those prices will go up and down. Supply and demand will push that. Any number of things will push the physical real estate price. But the mortgage notes tend to be a more consistent flow and consistent income stream. When I compare a mortgage REIT or credit REIT to a bond, depending on the bond may be backed, it may be more secured. I don't know how it's all set up. But mortgage REITs provide an incredible hedge to a lot of physical real estate holdings. That's really the last part of the conversation here. We talk about the Amanda case, and my solution was we're going to buy this beach house. We're going to spend over $1 million one day. We're going to buy a beach house. To Amanda, that's going to be one of the biggest assets. So what can hedge that? Well, insurance, certainly, right? We want property casualty coverage on the house. We want to make sure we have flood insurance on the house. We want all the insurances on the house. That's some protection. But the other protection is about value. What do we do if the beach house goes down in value? Well, something like a mortgage credit REIT is going to go up in value when the beach house goes down in value. So we need to think about it from the standpoint of what can we buy if we have one big physical holding maybe we buy something in the mortgage credit space. Alternatively, and this is more sophisticated than that Amanda case, but we might look at timberland and land to help offset some large real estate holdings, right? Until this graph, I don't think anybody watching would have thought immediately gone, I should buy some walnut. But when we look at timberland and land through the verge of managed products, having a little bit of that's going to go a really long way. If we have a bunch of apartment buildings and downtown properties, maybe we can carve 20% of that out and go more into the rural agriculture area. Again, a more balanced, friendly portfolio. So your takeaway is this. Look, owning real estate's great if it makes sense in your portfolio, if it's sophisticated, if we need diversification. Real estate can be awesome. But how we own it and make sure we're not doubling up, right? We don't want to buy the dark blue areas. They're not doing us any good diversification-wise. And make sure if we have a broad enough portfolio, think about those light green, think about where the correlations aren't huge. And we can do a lot better with our clients if we pay attention to how real estate works together when we build a bigger portfolio.